Welcome back to the Educated Homebuyer Live, where our goal is to help you buy right, borrow smart, and build wealth through real estate ownership and financing. For those of you who don't know, my name is Jeb Smith. I typically have a guest with me, Josh Lewis, certified mortgage professional. He's going to be here. He's actually on a phone call running a couple of minutes late. So, what we're going to do in the meantime, we're going to talk about some things that are happening in the mortgage real estate world at the moment. And then when Josh comes in, we'll talk about interest rates, get a little bit more detail on what's happening there, answer your questions, have some fun, and whatever comes from that. So let's start. So we all know interest rates are above 7%, have peaked above 7%. That's put an impact on buyer demand, causing mortgage applications to go down. Just a lot of craziness in the market in general. We actually saw the 10-year today actually come back. We've had the best run we've had in about a week over the last couple of days. So the 10-year now is just sitting right above 4%. There's some expectations in the market that we could see it trace lower, but that we're kind of more or less in this pattern, if you will. And again, we'll have Josh kind of jump in here and give us some context on what that pattern looks like, how long we're expecting to see it. Because what happens is next Wednesday, this time, the Fed will have come out and adjusted the Fed funds rate 0.75%. Right now, it's 99% chance that's what they're going to do. And at the moment, it's looking like a 50 basis point hike in the December meeting. So there's a lot of questioning at the moment whether the Fed will decide after that second uh, Fed funds hike in December, the first one being in November, second in December, whether or not that's going to be the pause, the pivot. There's actually some very prominent people on the Fed and around the Fed now coming out and saying, listen, you've got to pause, you've got to pivot because the things that you're doing, you're kind of front loading the market without actually seeing what the repercussions are from all of this stuff that you're doing. It takes months for, employment to get affected, for, some of these things to actually happen. And all you're doing is continuing to fight inflation without actually looking at, how this is going to impact us 3, 4, 5, 6 months from now. So some talk out there that could be the pivot, the pause, at which point, hopefully less volatility in the market, allowing interest rates to come down a little bit, but we don't really know, right? At the moment, market is continuing to slow. You've heard me say it, on multiple videos, on podcasts, what have you. If interest rates continue to rise, we're going to see, home prices go down further. At the same time, if we see some sort of stabilization in rates, you're likely to see uh, home prices more or less move sideways. You're going to see some downward movements in some of these markets, depending on what the seller's motivations are. I actually talked to someone today, and we were having that conversation, and it was what, why, how difficult is it at the moment to convey to a seller what the value of their house is? And I said, it's difficult because what's happened is like like we were 2 years ago when the market was moving so fast upwards, it was hard to tell a seller, hey, listen, this is where your house is going to sell because things were moving so quickly. Kind of conversely, on the other side, it's opposite, right? It's what do you price a house at the moment? Well, things are kind of moving faster in the slowing side than they were, 6 months ago or what have you. And so, how do you price a home now? Well, you've got to again look at the most recent stuff. In some markets, things are moving downwards, quicker, faster than other markets. Here in Southern California, if you guys have watched my videos at all outside of these, I've talked about the last two offers that I put in. Neither were a success, and both were at or above the asking price. And so, some house prices or some markets are continuing, even though they've slowed, are continuing to fetch, premium prices in these markets for specific types of properties. And we actually talked about it this week in the podcast. If you go out and check out that episode on the Educated Home Buyer, those of you guys who follow both, we actually talk about which properties are still selling quickly, which properties are sitting on the market a little bit longer. Next week, we're talking about opportunities in the market. So next Tuesday, if you tune into that episode, you can check out that. But again, that information is different than the information we talk about on here. This live will be on there Friday, so you'll get to be able to listen to this in its full audio if you choose to do that every Friday, and then every Tuesday we post an episode where we deep dive into the market. So with that said, I've promised that I'll reach out to a couple of different agents. So we actually have a couple of different agents coming on next week to talk about their respective markets. We've got Austin, Texas coming on, a market that's seen 160, 170% increase in the amount of inventory. So it'll be interesting to talk to some top agents in that market, that do quite a bit of business, to see what they're saying. And also we have an agent coming on from Baltimore, Baltimore, Maryland, a little bit different market. We haven't talked on this channel to anybody in Baltimore. So that'll be a good, a good feel for, that market out there around Baltimore, parts of DC, maybe Northern Virginia, some of that market, just to get an idea of what's happening there and what those markets look like. And I've also reached out to other markets, just waiting to hear back on when they can come in and when we can get them on the channel, so that you guys, have a different take from different people in different markets. I've reached out to somebody in Vegas, somebody in Tampa Bay, Florida, somebody in Portland, Oregon, Fort Wayne, Indiana, just a little bit all over the place. So Josh, I'm going to hit this, buddy. If you're ready, throw you in here as well. Camera looks to be a little out of focus. No.
Since it does autofocus and I'm not good at focusing, it better get it
closer to the camera and then pull back, and it might
maybe I'm fuzzy. Maybe I
there you go. Finally came in. Perfect, guys. So I changed my setup a little bit. So now I'm looking the other way. This whole thing is a little bit weird. But what I did, Josh, is kind of set it up, talked about, the 10-year currently, kind of the expectations is that it might trade in a range, right? We pulled back. We're sitting somewhere around 4%. Today, what does that look like? Is that, is this range that we're supposedly going to be in just for the next week until the Fed comes out and raises the Fed funds rate 0.75% next Wednesday? Or is this something that we should continue to see further? What are the experts saying?
Well, hey, that's the fun part. You sent me a video last night. We had talked about, I had seen an interview with him a few weeks ago, but we have some really smart people saying, hey, Fed's out of their minds, have gone way too aggressive, and this is going to be problematic going forward. They need to stop this. There are also some really smart people saying, no way, the Fed's doing exactly what they need to do, and they need to stay the course despite what anyone says. So right now, this range that we're in from 4 to about 432 on the high end says that we've absorbed all the information. There's uncertainty, and we'll probably chop in this range. There is a path maybe down to about 3.87 on the 10-year without really changing the big picture, but it would just sort of expand that range from 3.87 to 4.32. That's a pretty big range, 0.5% when we're talking about 4% in total. You're talking 12.5% of the total yield there in range in a fairly short period of time. Right. So big picture, what does that mean to us, to you, to the market? There's still a lot of uncertainty. I am of the opinion and being swayed by some very smart people that they're going to stay the course. There's nothing changing that 0.75%. The market would be upset at this point if the Fed surprised with anything less than 0.75 next month or next week. Now, we have another meeting before the end of the year. Right now, that says 0.5%. Barring some additional really negative news, that probably stays on the table. I have pretty significant questions about what happens next year. Do they drop down to 0.25% a meeting? Do they just step back and watch it? Jeb, I just sent you a chart over here. We had talked this time last year here for us in Southern California. You had ships lined up all offshore here trying to wait a week, 10 days to get unloaded. We had an excess of containers. They were dumping them in neighborhoods in Long Beach. Now that chart just fell off of a cliff.
Josh, let me stop you 1 second here. A lot of people are saying it's blurry. Is it still blurry? I'm watching it on my feed. I've got it on 2 different feeds here. I'm actually watching it on YouTube as well as my side, and I'm not seeing any blurriness. So can you guys comment and just let us know if it is blurry across the board? Because again, what I'm seeing is clear. So I'm trying to see if it's somebody else's connection or our connection. But anyway, Josh, keep going, buddy. Sorry.
No, just saying that there's a lot of those signs. The all of the freight indexes are coming down. So that says, what does it tell us? When we don't have ships offshore backed up to get unloaded, it means there's not a bunch of goods. We had talked a month or so back. Nike, several other big companies said we are going to have to aggressively discount for the rest of the year because our inventories have backed up. We had supply chain issues. We ordered a bunch of stuff. Supply chains cleared, and now we have too much stuff. Now we're looking, and they're saying we're not bringing in as much. We have backed up inventory. We're not going to bring. So that tells us going forward, growth is going to be slowing. The argument from people who are saying the Fed is just out of control is that they're looking at lagging indicators and saying, hey, great, we've raised rates, we've done this, we've done that, and we're not seeing the impact that we want. They're looking at lagging indicators. The leading indicators, those freight indexes, inventories, are telling us that the economy is going to slow down. So it will be interesting to say the least. And I still go back to Jeb. I don't know what your thoughts are, but I still think it's going to be Super Bowl, March of next year before we really know where we're at. That's 5 months or so away. If rates are at five and a quarter, five and a half, then we'll see some additional supply in terms of sellers being willing to sell and buy. We'll see some additional buyers coming back into the market who were priced out in terms of monthly payments. You and I just looked at another chart showing the impact of both price increases and interest rate increases. And over the last 9 months, the biggest difference in terms of monthly payment is all due to those interest rate increases.
Yeah.
If we back some of that off, we will have more able demand. Not again saying that it's going to shoot off like a rocket and take off to another bull market, but it will give us support and lead more to that sideways trending market for the next few years versus this big correction that some people are calling for. I mean, you guys have heard me say before, I like to say, okay, so you told me what your hypothesis is. What has to be true for that to be right? So these people calling for a 5, 10, 15% decrease in home prices, what has to be true for that is rates have to remain elevated and probably go a little bit higher from here. It might be enough for them just to stay at 7% for a couple of years. That may be enough to keep buying activity low. And there will be some people that need to sell, and those prices will need to come down. But for the most part, it's dependent on what happens with interest rate. Incomes will continue to trend slightly upwards, but that doesn't make a huge difference over time. Prices we've talked about are sticky to the upside. And the one variable that can move rapidly in a short period of time is interest rates. We've seen the bad
Yeah.
side of it this year, hoping to see the good side of it here shortly.
Yeah, no, it definitely is. And I think, I've talked about it, and I don't think, even I was probably, as much as I follow interest rates and payments and what have you, I guess I didn't even understand how much home prices would have to drop if rates stayed high in order to make those payments quote unquote affordable, right? I talked about it recently in a video, and that it's interest rates have such a huge impact. And I've talked about it before and on videos and in fact, in the last video I did and what have you, and that, people want to say that they want a lower priced house. They want the lower priced house. They'll take a higher payment because they can refinance and whatever later in the future, or they want the lower priced house so that they can pay it off quicker and it's less interest that they're paying over time. What I get that, and it all makes sense. But what I can tell you, knowing, been in Josh's shoes, been on the mortgage side, knowing people that, a lot of people that have mortgage, very few people actually pay more on the principal of their mortgage to pay that mortgage off faster. In fact, I only can name a few that I know of that do that. In fact, most people, as soon as their house value goes up, they refinance and take the cash out. So they're only adding to the balance versus paying it off. So, it's the same thing with car loans. Why do people get leases? Because they're less expensive. People live in the payment and not the price. And yeah, it sounds great to say, I just want the lower price house, because that really is the right move. That is the right answer. But the reality is people live in the payment. And if interest rates, the biggest improvement to housing is going to come in the form of interest rates. And it would be ideal if you had both house prices decline and interest rates decline at the same time, but the two work adversely to one another. Can you have a little bit of both at the same time? Sure. But over any extended period of time, any big moves, they're going to move opposite. And right now we know that interest rates follow inflation. And so in the next couple of months, you should see inflation numbers come down. Now, does that mean immediate interest rates are going to drop immediately? It doesn't, but it could just put the slowing in the market. And during that slowing time, you might see home prices continue to move sideways, potentially down in some markets. That's the reality. But I think if interest rates were to come back down into the low fives, I think it's going to get some of those sellers that are on the fence off the fence. Some of those people that potentially would be buyers, maybe making the move. I just don't see a world in which we can get house prices to drop enough in order to make, to give people the opportunity to have payments like people that purchased in 2020 or even in 2021 for that matter, Josh.
One thing that you said that kind of triggered a thought, a news item here this week. We don't know exactly what this is going to look like or what these numbers are, but for some folks in some parts of the country, this is actually important. The FHFA announced that for Fannie and Freddie this week, one, that's the negative news. They're going to be increasing the loan level price adjustments for cash out loans. So in the future, cash out loans are going to be more expensive than they are right now. They already did that earlier this year to a degree. So just again, more bad news. But what they're doing is trying to incentivize or give access to the housing market to low, moderate income borrowers. So anyone that's home ready, home possible eligible, which is essentially 100% of the area median income, will have no loan level price adjustments on Fannie Freddie loans, which doesn't sound like a lot, but it can be significant, especially like right now, a borrower with say a 650 credit score would never do a 3% down Fannie Mae loan because the loan level price adjustments are monstrous. So instead of getting today's 7% rate, you're looking at 8.5. If the lenders would pay up for it, more likely it means 7.625, and you paying 2.5, 3 points for your loan. So when you eliminate all those loan level price adjustments, anyone at or below 100% of the area median income, and some of the things I was reading were saying 120% of the area median income. And the reason why I'm saying is some parts of the country, this is going to be great news. For us in Southern California, even Inland Empire, it is very hard for someone at 100% of the area median income to qualify for any single family residence. Maybe some of the lower priced condominiums, that works. There are parts of Central California, the Central Valley, Bakersfield, that type of stuff, where it absolutely does work. But the Bay Area, even like Sacramento type stuff, it's going to be very difficult. So if you're in an area where you can be at 100% of your area median income and qualify for a median priced home, it's going to get cheaper to buy while we're also seeing interest rates decreasing over the next couple of years.
No, agreed. And be prepared, guys. We're headed into monstrous election, times over the next 2 years. You're going to hear a lot of people on both sides talking about affordable housing, what they're going to do to support it, what they're going to do to make it better, and realize there's nothing they can do to make it better. So don't vote based on that. And if they're talking about first-time home buyer programs, you guys all know, you guys have been still reaching out on videos that I made 2 years ago, asking if that's available or when it's coming. And guess what? It hasn't. So just know it's politics season, baby. And it's gonna be, there's gonna be a lot of talk out there and very little action at the same time. With that said, Praxia became a member of the channel. So thank you for doing that. Josh, anything we want to touch on here before jumping into some comments?
No, I think we covered it. That was the big news on the mortgage side. Still just a lot of uncertainty. So
Yeah.
we got to watch it unfold. I had a client today ask, he's a fireman. He goes, hey, several guys at the firehouse looking at buying second homes, and they just don't know what to do right now. So if it's a second home and you're not looking at putting a roof over your family's head, we probably want to wait 3, 4, 5, 6 months and see how this shakes out and get a little better insight into the spring buying season before we know. So it's just a different market right now. We don't have any of you. No one should have any fear of missing out right now. If anything, you're going to get more information. So if the timing is right for you and your family, great. If you're uncertain or unsure, do your due diligence, do your research, get more information and get more educated and get a little more, not even educated, just get a little more insight into where the market goes over the last few months.
Yeah, and inventory continues to kind of stall. It's not really going down, and at the same time, not really. I mean, it is going up a little bit, but not enough to really report. Orange County, 3,630 properties today. I think we're in the low 3,600s last week. Huntington Beach sits at 258, so a little bit more inventory there, but not a ton. And what you have to realize, guys, is it's not new homes coming to the market per se. It's just the fact that the homes that are on the market aren't going into escrow like they were. There's not as many buyers out there going under contract on those properties, taking them off the market, and therefore inventory is growing. Because, it may seem like, hey, listen, no one's buying property, so every time the market goes up in inventory, it's because new properties are added. No, there's always some buyers in the market, and so they're taking away as homes are coming on, and so kind of a 1-for-1 exchange. Well, now there's less than the 1-for-1, right? So every property that has come on, maybe instead of having one buyer or one buyer for 10 homes, now you have one buyer for 20 homes or whatever it is, just because of interest rates, affordability, time of the year, all of that stuff in one. It's definitely, I mean, guys, it's a tough time to be a buyer. I'm not sitting here cheerleading saying you need to go buy a house. I want to be very clear on that. But I do know I have clients looking for property. I mean, we are writing offers. We are out looking, I'm closing on a property tomorrow. Closing on one next week. There's still people buying property. So if you're going to do it, you just got to make sure you're, dotting the I's, crossing the T's. Is there an opportunity for lower prices in the future? Possibly. Is there an opportunity for rates to go up? Possibly. And what we've shown you is that by interest rates going up and prices going down, it's still less affordable to buy that house. So just know the facts and buy for the right reason. That's it.
Jeb,
So,
just
yep.
sort of seconding that. I was out of the office this morning and early part of the afternoon helping my nephew with
Dude, he was
something.
cleaning his garage today. I mean, that's what
Yes,
mortgage people do these days. They clean their
exactly.
garages on a Wednesday.
Super organized. And by the time I got to the office just after lunch, 3 new buyers interested in getting into the market. We talked about this last time. 2007, 2008, most people would say that was about the worst housing market ever in terms of home prices coming down very rapidly. We still had 60% of the buyers that you had the year prior. People buy in all types of markets. Once someone becomes a homeowner, for the most part, they want to remain a homeowner. So everyone has different reasons and everyone makes that decision. And no matter how bad a market can get, there's still going to be a lot of people buying homes. I think we had 3 to 4 million homes sell in that time frame in a year. It's still a lot of buyers in the market at any and all times. So just here to educate and inform, let you know where the market is at and make the best decisions for you and your family.
Good stuff. Good stuff. All right. So let's jump into some questions here. Josh, we got a couple of them starred. Bill D was on earlier. Not sure if Bill's still here, but says, started my first rental property earlier this year. I've always done my own taxes, but I'm considering getting a tax professional this year because of this rental. What is your advice? So there's definitely some things that you can do on a rental property that you can't necessarily do on your primary, and without knowing tax codes and all of that. I mean, I'm a believer that you should get a tax professional regardless of where your situation is, just because they know the tax code. They understand it. They know the quote unquote loopholes of things, what you can get away with, what you can't, things that you might not be thinking about, all of that stuff. So I'm a believer, regardless if you have a rental property, it's good advice. So I think, yeah, even more so with a rental property, because you can depreciate, you can, there's expenses and things that you can add in there and all of that good stuff. But Josh, coming from somebody that's got, 5, 6 rental properties at the moment, what are your thoughts on it?
I just because of the corporation, I will always use a tax preparer. But in terms of if I had a simple W-2 position and felt that my tax return was easy that I could handle, a Schedule E for declaring rental income wouldn't be something that would tell me, hey, I need to go get a tax professional. You hit on the big important ones, Jeb. You would want to know how to accurately and properly depreciate the property on your taxes. That would be one piece of it, and the other one. I I had another thought with that, and I completely lost it. But what I can say is, we have a property where a tax preparer can come in and be handy. So the second piece was your tax preparer can help you in terms of documenting and keeping track of anything that would add to your cost basis in your property. You put a new roof on it, things that you can add to your cost basis that will decrease the potential taxable gain when you sell. That would be important. If you get into a complex situation, we have that property that I renovated and kept as a rental last year. We did a ton of upgrades to that property. So we did a segregation analysis on that that I wouldn't be comfortable doing myself, that the tax preparer did, so that we could do some accelerated depreciation on some of those things. But a fairly simple, straightforward rental is not all that difficult. Something that I suggest, I don't know if you have done this, I have a different bank account for all of my rentals, for each of my rentals, I should say. They all have their own bank account. All rents get deposited in there. All expenses get paid out of there with a debit card. It makes it really easy at the end of the year to just print all activity and go to the tax preparer, or go to yourself and put into TurboTax. Here's what I gained in rents. Here's what I paid out in expenses. Throw in the depreciation figure, and you'll be pretty good. So I wouldn't fault you for going to a tax preparer, but I wouldn't necessarily default to saying, hey, you have to use a tax preparer just because you have a rental.
Good stuff. Proxia says in my immediate market about a square mile near Olympia. That's a market, Josh. No houses are coming to market at all over the past few weeks. We normally see at least a half a dozen in a normal market. So what I want to say is that, what's a normal market, right? So when somebody says that, understand the time of year, understand, like, for example, a normal market. This time of year, a normal market would be very few homes coming to the market for us here in Southern California, just because you're headed into, Halloween. Again, Halloween really has no bearing on property, but it's just that time of year, right? Followed by Thanksgiving, Christmas, just less activity in general, less people coming on the market. Like if a seller came to me today and said, Jeb, should I put my house on the market right now? We would talk about their goals and what they're trying to accomplish. And if they were trying to maximize price, I would probably tell them to wait, just because it's that time of year when things are slower. Rates are high. It's just less activity in general, on top of an already slowing market in general. So when you say slowing or what have you, yeah, it probably is. And some of these markets, like, I don't know if Olympia gets, snow or colder weather, if things really halt when things start to change. But some of these markets, they do, right? And if you're in a market probably like Wisconsin or one of these crazy towns that goes below zero and feet of snow and all of this crazy, those markets probably stop for the most part for a couple of months. And so activity in those markets are going to go down quicker than others. Yeah. Do you want to say something there, Josh?
No, it's a good market. They get rain. It's basically Seattle. So you're an hour south of Seattle. A good market, a big market. Like, I would be shocked if there were really only a handful of listings. It's a fairly big city. It's the state capital. It's not a huge city, but it's a fairly big city. Also includes some neighboring cities there: Lacey, Tumwater. Although most people that want to be in Olympia don't want to be in those cities. But look at all of them. It could literally just be what we've been talking about here. Sellers are kind of on strike, waiting to see where they can go at a reasonable amount.
Good stuff. So Willing's got a question that's a little off topic, but I thought about putting it up here because I think we've probably all been there to some extent. Basically, it just says, drove an hour to an event just to get there and be too afraid to go in. Fear ruled the day. Was afraid that I would be called on to speak. Feel defeated. So Willing is currently, I think, in the mortgage business, trying out the mortgage side of things. Josh, have you ever been in a situation where you showed up, didn't want to go in for the fear of having similar result as to what they said there?
I would say no, I've never had that, but probably for an unexpected reason. You guys at home may not know, I am incredibly antisocial, so I will just stay at home. So I would never have got there and not wanted to get out of the car. I would have been at home going, thank God I didn't go there. How about you, Jeb?
Yeah, I have been. Even after several years of being in the business and what have you, I don't like to public speak. I don't like to be in front. In fact, I don't like to be in front of the camera, guys. You rarely see me on anything outside of YouTube, like videoing myself or doing any of this sort of thing, just because it's not who I am. I'm a lot like Josh. I'm kind of antisocial to some extent. But yeah, I've showed up to broker previews as a agent and to other events where I was like, not because I thought I'd be called out, just because I didn't want to be in that uncomfortable position. But you know what I will say is that it's in your head. Like nobody is worried about you, and not just saying you, just me, Josh, whoever. Nobody cares. There's this saying, and I'm going to butcher this thing, but it's like in your 20s, you worry about what everybody's saying about you, and then you get into your 30s and you realize, you know, something, and then when you get in your 40s, you realize that they weren't thinking about you at all, or something along those lines. And that's the reality. The older I get, the less I care, just because I think, nobody really cares to start with, unless you're on YouTube, then everybody has an opinion.
One of my mentors, this was not something he said. He quoted someone else in a podcast last week. He said, "Listen, stop worrying about what other people are thinking about you. They're not. They are too
Yeah.
busy thinking about themselves." And I'm not saying they're turds or they're selfish. They don't care about you. They're dealing with their insecurities and their problems and their issues. They're not worried about you.
Well said. This is a crazy question here. I'm a bit like shocked in this whole thing. So Ingrid, I want to know Ingen, I want to know where you are. Name says maybe overseas somewhere, but I'd love to know where this is, just so we can get some context on the market. But it says, I just got hit with a big special assessment for the condo I live in. It's $88,000 spread over 24 months. So they're asking for an additional $3,700 a month. Will this count against my DTI when shopping for a house? And the answer is absolutely. It's going to come up, likely going to come up. Josh, how would a lender find out about an assessment?
Well, they make us so if you own a condo and you're trying to buy a new home or new condo, whatever, we're going to have to provide documentation of what the HOA dues are. Most likely your monthly statement from the
Jersey
HOA
City.
or a letter from the HOA stating what the monthly assessment is and asking, are there any special assessments outstanding as well? So I'm not saying it couldn't squeak through, but it probably would. And the way the new loan application, our old loan application, the Fannie Mae Form 1003, which we'd had for 20 something years with no changes, it had a vague declaration section on page 3 where you had to answer some questions and you could honestly answer them and still hide information. We got a new application a couple of years ago and it asks some very specific and pointed questions, and for you to answer those honestly, you would have to disclose that you have this debt.
Wow. So it seems to be it's Jersey City. Looks like they needed $4 million to execute a project. Building is not getting a loan, so it's totally funded by the owners of the project. To me, this sounds like a golf course, where you have ownership, right? And they want to build a restaurant on site, and so they take that restaurant and they divide it amongst the members, and then you come in. And the only reason I use this example because I know somebody that was in this situation, but on a house, $3,700 a month, crazy. What's the value of this property? I'm interested. You got me intrigued now. I want to know more. So it's repairs. He said, but I'd love. I think it's a he. Sorry if it's not. I'd love to know exactly like what price point are we looking at here? I'm uh, I'm on the edge of my seat, Josh. Kim says, since the interest rates have skyrocketed, will the home buyer programs increase also? So
Unlikely, because most of them they set income limits relative to the area median income. So we talked earlier in the show about Fannie Mae removing loan level price adjustments for anyone at 100 to 120% of the area median income. Um, that is who they are trying to help. And for those of us like you here in Southern California, the prices have gotten so high that if you're looking to buy one, you're going to be above those levels. And the feeling in Washington D.C. and among lobbyists is that, hey, if you can afford a $800,000 house, you don't need our help. People not realizing that in Southern California, a lot of these communities, that is the bare minimum to get into an entry level home. And I'm not saying a nice neighborhood, upper class neighborhood. I mean your working class normal neighborhoods in Southern California. A single family is going to run you 700 to 800 in the most affordable cities for most of us.
Good stuff. Goes on. I'm gonna go one back here and just go back to this question one more time. Says, what if I have cash to pay for the assessment plus required funds to close on the new property? So if you can pay the assessment off, then it wouldn't count towards your DTI. But as long as you have not paid that assessment off, that monthly amount, and Josh, is it if it's less than a certain number of months, they won't count it, or they're going to count it until it's paid?
I, I would have to dig into Fannie Freddie guidelines. My gut is you're going to have to pay it. So installment debt with less than 10 months remaining can be excluded. So you might be able to use that angle. If it's a portfolio lender, so a bank, someone that's doing their own programs, they can make their own decisions on this. And if you're in a strong financial position and you have the additional funds setting aside, there's a possibility. I wouldn't count on it. It would be more likely they would say, cool, you have the money, pay the special assessment off.
Got you. So in which case you didn't have the special assessment, that's not going to hit your DTI, but you'd still have to be able to qualify for the other house. So
And
hopefully that
he
was
followed up here. He doesn't want to pay if he's getting 4.5% with treasuries. Remember, treasuries
fair.
aren't risk free. If the treasury is going to go back to 3.5% this time next year, you're losing value on those when you go to resell them. Unless you're, I mean, forgive me if you're, because the yield curve is basically higher, you're getting greater yields on the short-term stuff. So if you're talking 3, 6, 12-month treasuries that you're getting 4.5%, you're just going to hold them to maturity, then you don't have any risk of rates going lower.
There you go. So we answered that. Al says, do HELOCs also have loan level price adjustments since cash out loans are more expensive? So Josh, when you get a HELOC, are there certain price adjustments for different things on those as well?
No, because it's not a Fannie Freddie loan. So I shouldn't say no. I should say it's dependent upon the lender. So it's not underwritten to Fannie Mae, Freddie Mac guidelines. So the FHFA isn't telling them, hey, you have to charge these loan level price adjustments to compensate for the risk. The lenders make it up themselves. Now, I have lenders that are all over the place. Generally, they will charge a higher interest rate, either in the form of a higher margin, or if it's a fixed second, just a truly higher interest rate. The higher you go in loan to value, the lower you go in credit score. So there is a risk-based pricing element, but not true loan level price adjustments the way you think of them in terms of a Fannie Freddie loan.
Good stuff. So Anya says, is buy down rate fixed? So Josh, there's two types of buy downs, right? There's a temporary buy down. There's a permanent buy down. Maybe talk about both quickly. And then I have a question for you because I watched a video today that had me asking myself a question that I didn't know the answer to.
Absolutely. So this question is coming up a lot. There's a lot of loan officers out there that are trying to sell buy downs and they don't understand them and don't know how to explain them and don't know how to sell them. So a temporary buy down, which you've heard, a 1-0 buy down, a 2-1 buy down, a 3-2-1 buy down, that is temporary. So the most common is the 2-1 buy down. For the first year, your interest rate is 2% below the note rate. For the second year, it's 1% below the note rate, and then it adjusts to the note rate for the remaining 28 years. So obviously that is temporary. The permanent buy down, and just to put it in context, that 2-1 buy down costs a little bit less than 2 points. If you used 2 points to buy the rate down permanently, you would buy the rate down about 0.5% is sort of your rule of thumb. Sometimes a little more, sometimes a little less. But if you do that, you're going to get 0.5% lower for the full 30 years of the loan. So there's permanent buy downs, there's temporary buy downs. So we're talking about a 1-0, 2-1, 3-2-1, it's temporary.
Got it. So, but there are ones that you're actually buying down and they are fixed. I don't know. Did you say that? I was reading something else.
What was the question?
If you do a permanent buy down, did you talk about permanent buy downs as well?
Yeah.
Okay, got it.
Yeah.
So my question that I saw someone else on a video today say basically on a 2-1 buy down, for example, the money that you're paying to buy that rate down on the 2-1 buy down. So basically you're not saving any money. So say, for example, you get a 7% rate. And so the first year that rate is 5%. The second year it moves to 6%. The third year it moves back up to 7% and stays fixed at 7% for the remainder of the loan. So it costs money, like you said, to buy down that rate, doing that 2-1 buy down. So are you paying essentially for that savings in the amount you're paying down, or is it a different amount? That makes
So
sense?
it basically it's an interest rate subsidy, right? So the lender is getting 2% interest less the first year, 1% interest less the second year. So where does that money come from? That's the buy down cost. When I say, depending on where interest rates are at, loan size, it'll vary a little bit, but it's a little bit less than 2 points. So you can pay for it out of pocket. The seller
Mhm.
can credit it to you, which you're paying for it in the purchase price. You're still paying it. And then the third way is you could take a higher interest rate. Lenders are not paying big premiums right now. Normally, we could say if the rate's 7, if you go to 7.5%, that would give you the 2 point premium. So you would be 5.5 for the first year, 6.5 for the second year, and then go to 7.5 for the remaining 28 years. So you're basically paying it on the back end. And what would the benefit of that be? Would be, hey, I think rates are going to be lower in the next 2 years, or I'm only going to live in the property for 12, 14 months, which would be kind of crazy in any market, but definitely in the current market. So the important thing to remember, the thing that is cool about a temporary buy down, is that money is not a check that you're paying to the lender at closing. It is money that's going into an impound account to subsidize the missing interest for those first 24 months or first 36 months or first 12 months. So what that means is we get to next spring, and let's say rates have dropped to 5.5%. You can refinance, and the amount that is in that impound account will be deducted from your payoff. So you owe $300,000 and there's still $7,000 in that account, or $4,000 in that account. Your payoff now becomes $296. So on that temporary buy down, any amount that you didn't use before selling or refinancing is credited back to you. The permanent
Got it.
buy down, as soon as you pay 2 points to buy that rate down 0.5%, that's money gone, sunk cost you will never get back if you had an opportunity to refinance in the first 1, 2, 3, 4 years.
Got it. So I guess, and I've heard you say it, and I guess it just didn't click. That money goes into an impound account, and so that all makes sense now. So okay, good stuff. So hopefully that helped you guys understand it. Patrick says, "What incentives are builders giving to buyers to help? Any advice on making the best from the situation, maybe to buy down rates or upgrade?" Thanks. So in my market, we don't have a lot of new construction, but I will tell you, if you guys follow Jason Walter at all. I follow him on social media and we chat back and forth occasionally, but he posted something today where a builder had reached out to him offering, I think, 5% commission to the buyer's agent, right? 6 months ago, actually more than 6 months ago, a year ago, builders were offering like 1% for us to show a property, right? Because they didn't need us. Everybody was going to them. Now there's no activity. They're offering quite a bit of commission to get somebody in to show property. So builders in some markets are hurting a little bit more. They're more incentivized at the moment to try to help you buy down. We've had several people on here tell us stories about builders giving credits to buy down the rate. So yes, there are opportunities out there. They're going to be different in different markets. We had someone else, I mean, I think it was on a video where I was reading some of the comments today, and they said the builder wasn't willing to do anything with them, wasn't really willing to negotiate at all. And I said, well, maybe you're in a market where just, they don't need you yet. There's not a lot of excess supply. And so in those markets, you're going to have less of it. But if you're in a market where there's tons of it, they're going to be more incentivized to work with you. And that could be in the terms of potentially lowering the price. It could also be in the case of giving you credit towards closing costs, buying down rate, maybe even credit towards design in the house, all of that good stuff. There could be a lot. You could maybe get all of it in some cases in some of these markets. Charlie says, what are the cons to doing a 7-1 arm in this market? Josh, what are the cons of doing an arm in general? Let's just go there.
So the downside would be that you get trapped into that loan. Interest rates never go lower. And that at the end of the 7 years, the end of the 10 years, rates are higher. You haven't sold the property. You don't have the opportunity to refinance at a lower rate. So at that point, you have to say, what did I save? A common number is about 0.5% below the 30-year fixed, maybe a little bit more for a 7.6. So let's say you save 0.75% interest for 7 years. Well, depends on how much higher it goes for the next 7 years. If it went on average 0.75% higher for the next 7 years, then you're at break even. And then if you stay above that for the remaining, 16 years of the loan, you would have lost money. That doesn't account for the time value of money, and that today's dollars are more valuable than the dollars at that point. And with inflation, home value increases, blah, blah, blah. It mitigates some of that cost, but really that is the only risk. We get the question on the show here all the time. I hear people are doing ARMs again. ARMs led to the crash. ARMs in and of themselves did not lead to the crash. A specific type of ARMs, option ARMs, where the loan didn't amortize, it actually grew every month, and basically teaser rates in the form of 228 and 327 loans that in 2 to 3 years would reset to a massively higher interest rate. They had huge margins, were tied to a volatile index, and you were locking yourself into significant increases in your monthly payment in a very short period of time. Most ARMs being done today are more than 5 years and less. You have to actually account for a payment shock when qualifying the borrower. Since most people want to use this to help qualify, you're using the 7 year or the 10 year because we can qualify at that start rate. And the reason why lenders are comfortable with that, the reason why the government regulations were written that we're comfortable with that, is that in 7 to 10 years, if you have 2% wage increases, you're making 15, 18, 20% more than you're making right now. Home value should have gone up 10, 15, 20%, and you likely either moved and sold the property paying off the loan or refinanced at some point in that time frame. But the risk, the question you're asking, it's purely interest rate risk. And for a 7-year ARM, if you're getting at least a 0.5% savings, you're going to be positive out to about 9, 10 years in your worst case scenario.
Good stuff. Ingen came back on, basically gave us all the info we needed. So it says the property was 800 to 850. So that's a 10% assessment on that property. That is nuts. So if you guys are ever wondering, I mean, it goes on to say 2-bedroom, 1,000 square foot condo, 3 patio doors and 4 windows is 55 grand, 33K for just the brick facade repair. So if you're ever wondering about some of the downsides of condos, it's that sort of thing, right? I mean, that's unique to me in hearing that. Maybe not in Jersey City, maybe that's a more common thing. But I think more of these buildings, probably after the Miami disaster, are probably going in, making sure that they're not in some crazy, position for something like that to happen. Although I think that was probably a unique case in itself. But assessments, I mean, that's the craziest assessment I've ever seen. I think the most I've ever seen is maybe like 17, 20,000, somewhere in that, because what has to happen is the board has to vote on that, right? So nobody just assesses you that. The board in the community has to get bids, probably, where I am, 3 bids on this sort of thing. And so 88,000 might not have been the lowest, but it was probably somewhere in the middle. That's typically how they choose. And the community had to vote, right? And I would imagine even you as a homeowner had to vote on whether or not to approve this. So it's probably necessary, but still at the same case, I mean, I imagine there's people that might not be able to pay it, which is interesting in and of itself. So
that's the crazy thing with that short trigger on it. I've seen bigger than that, but I mean, like, these
2
were
years is up.
multi-million-dollar condos, and you had a long time. They basically
2 years is
carried
quick.
it over
I mean,
10
you
years.
would think I mean, but anyway, Evan has a good question here. But before we get into Evan's question, want to take a minute and ask that you hit the thumbs up, hit the like button if you find any value in what we're doing, subscribe to the channel. It helps the channel grow. You guys have been a big part of my success where I am at the moment. Josh has also helped with that by being here every Wednesday. So, show some love if you don't mind and hit that. And as I've mentioned before, Educated Homebuyer Podcast, that's also something that we do together. Post every Tuesday. Take this, live stream it, or take the audio from this, put it on every Friday. We're actually going to do an Educated Homebuyer YouTube channel, which, Josh, when's that going to be up and running? Putting you on the spot here.
Oh, shit. Let's stick with November 9th. Like we have our premiere night. We'll have the first 5 episodes up by then. I've got a lot of the legwork. I just got to pull it all together into one and get that thing launched.
All right. So we'll have a channel for that. We'll be able to send you over there too. So thank you guys again for the support. But let's get to Evan's question. Why are rates so much lower on jumbo loans versus a conventional loan? So maybe start, Josh. What is a jumbo loan versus a conventional loan? What's the difference in money wise? Like, what makes a jumbo loan? And then answer the question, why?
So let's look at it this way, and it's just different verbiage. Conforming versus non-conforming. Conforming means it conforms to Fannie Mae, Freddie Mac guidelines, the government agencies that loans can be sold to. Anything that falls outside of that doesn't go to FHA, VA, USDA is non-conforming. A subset of non-conforming is jumbo loans. When we're talking about jumbo loans, most people are considering that to be larger than the limits. So right now, 647,200 for all of the country. In some areas, it can be as much as 150% of that for the county loan limits. So let's say you want $1 million loan. Fannie Mae, Freddie Mac won't touch that in most areas. So you're going to a lender that makes their own guidelines. So for the most part, they require higher credit scores, bigger down payments. These are safer loans to that lender, and they can do just more due diligence, keep a little tighter bow on that. The other piece of it is a lot of these lenders are portfolio lenders. They're not selling them into the secondary market. So the big answer is the people who are buying jumbo mortgage-backed securities see less risk in those than they see in conforming Fannie Mae, Freddie Mac mortgage-backed securities, and they're willing to pay a premium for it. Now, when it comes to true portfolio lenders, it can be significantly different because they're not worried about the secondary market. They have funds that they're paying out 1.5%, 2% interest on, and if they can loan it at 4.5%, 5%, they're thrilled. So that's the reason why.
Good stuff. Good stuff. Side note, guys, because I just scratched my face and realized I had a beard here. The beard has to go this week. And you know why the beard has to go? Because it's Halloween weekend. My wife has us dressing up like Travis Barker and Kourtney Kardashian. That's what we're going to. So I, on Friday and Saturday, get the luxury of putting about 2,000 tattoos on my body. Going to be interesting to say the least. So if you're interested in seeing what that looks like, you should follow me on other social media because I'll be posting it. Coming to you guys hot like Travis Barker. Does he come in hot? I don't think so. But there's going to be a transformation here, guys. And it's, there might even be a head shaving. I might shave my head for this costume. We're going to see.
I don't think you'll do it. You're scared.
You don't think I'll do it?
Nope.
We will see, guys. Anyway, that's that. That is that. So we got a couple other questions here. Some, a question. Where did I go? Sorry, guys. Let's see. So we got that one. Kyle says, my credit is 800, 10% down payment, but my DTI is non-existent because I deduct everything. Probably self-employed. My friend who is a doctor said he'll co-sign for me. Is that allowed on conventional? Josh, can you have a co-signer on a conventional loan? What loans can't you have a co-signer on? How's that?
Jumbo loans will get fussy on a non-occupant co-borrower. Occupant co-borrower just means, hey, me and the other person borrowing, we're not married. We are going to live in the property together. A non-occupant co-borrower, by definition, is not going to live in the home with you, just like this situation. Some jumbo loans don't allow that. Some other non-QM, non-conforming loans don't allow it. FHA will allow it. VA will not allow it. Won't allow any type of co-borrower other than the spouse of a veteran. And Fannie and Freddie will absolutely allow a non-occupying co-borrower, even if you don't have any income. So in this situation, obviously you have income, you're paying your bills, but per your tax return, it says you have no income. So with that, yes, there are absolutely options for Fannie Mae and Freddie Mac. You may come across a lender who has overlays against it. So if you talk to a lender and they tell you no, not against the Fannie Freddie guidelines, so feel free to reach out to another lender.
There you go. And with that said, Josh, it's something we don't plug or haven't plugged in a while. If you need a lender, real estate agent, even if you're months out from the process, do me a favor, click that link below. In fact, had somebody reach out today. They just got pre-approved through one of the lenders that we recommend, and now they're in the process of searching for a house. Joseph, if you're listening, he was in Indiana, looking in Elkhart, Indiana, and made a referral to an agent there today. Hopefully they're getting in touch and helping the process. So if you need someone, there is a link to that. Mari says, Ingen, I'm butchering this. I know I am. Just made me scratch condos completely off my perspectives list. I also live in New Jersey. So listen, you come here, you comment, it can help others. Some of the comments can, not all of them, some. Al says, are any homeowners doing refinances these days, Josh?
So 2 inquiries this week. Both obviously would like to refinance, or they wouldn't have inquired. One, the rate that she has when she saw what was available, although she wanted to cash out, just didn't in any world make sense. The other gentleman bought a home last year with a hard money loan, needed a ton of renovation, and now he's finished with his renovations. And unfortunately, rates have doubled. So regardless of what the rates are right now, he's going to keep that home. He has to get out of his high interest rate hard money loan. And even if the rate wasn't better, hard money loans generally have a 12, 24-month balloon on them, and that's the situation on his loan. He doesn't have the option. He has to get out of it.
All right. Round Earth says, don't be me and buy a house you end up not needing. I thought I'd enjoy the tropical climate on Houston. Never heard Houston referred to as the tropical climate, but until that horrible drought happened this summer, I wish I would have never bought in Houston. Yeah. So if you're looking to move to an area that you're not familiar with, sometimes it makes sense to rent for a period of time and just figure out, if you like it, if you don't, versus, I mean, there's a lot of people that made moves over the last couple of years without ever really knowing the area that they moved in. So I'm sure there's definitely some people out there that regret making that move, but a lot of those people are locked into super low rates and probably aren't going to do anything unless something changes. So yeah, just make sure you're doing your due diligence up front so you don't get caught in those situations like Mr. Round Earth here. Dina says, question when interest rates eventually go down, not if, when, will sellers likely put the high prices back up on properties again? That's a difficult question. I think you've seen the peak in prices for a period of time. I think even if interest rates pulled back, 5% ish, which would be about 2% lower than we are today. I don't know that you would see home prices just go crazy again. But it's difficult to say. I mean, I don't think anybody saw what happened 2 years ago, with things moving that quickly. I think some markets, depending on where inventory levels are, could see some appreciation. If you got a market that's got a ton of supply, a ton of inventory, the Austin, Texas markets. And again, I'm talking without really knowing these markets, just doing some reading, where Austin's up 100, inventory's up 160% from a year ago. Same thing with Vegas and Sacramento and some of these markets, but still, even though it's up, it's still lower based on historical data. Because there's so much more property, it would take time to work through that to get prices going crazy again. But I think you could see it put more of a floor in the price drops. Josh, anything you want to add on that?
No, what I would point out here is sellers. So she says, well, sellers put the high prices back up again. Seller doesn't get to determine the home prices. Let's go back last year. It wasn't that a home seller could go, hey, I'm going to ask $1 million for my house. They could put whatever price they want on it. The market was dictating it. Oftentimes someone says, hey, I want $850 for my house. 40 offers come in and they get $899 for it. That's the market saying what the value is. In the current market, homes that are less than stellar, you put whatever price you want and no offers come in. So the market will dictate where it's at. And just like Jeb said, we've lost a lot of the market momentum. I don't think a dip in interest rates, unless rates drop back to 2.5%, is going to bring people rushing back in and writing multiple offers. If we got rates under 4%, I think it would bring a ton of people on both sides of the fence. There would be a lot of inventory of people who were worried they got locked into their homes, so they would put their homes for sale, and they would obviously be out trying to buy homes. I don't expect that to happen, but that would be what we're looking at. And Jeb, Dina had another question here that she had asked earlier.
Yep.
My broker wanted me to pay off all my debt to be qualified. Does that sound reasonable to have no debt to get a mortgage? Just curious. My realtor seems shocked I had to pay off my car. Does it sound reasonable? It depends. There is a maximum debt to income ratio. So on most loan types, so on an FHA loan, you can have a maximum house to income ratio of 47 or 46.99, maximum total debt to income ratio of 56.99. So in that instance, you have some wiggle room there. On most conventional loans for well-qualified borrowers with good credit, you're going to either be able to go to a 45% or a 50% debt to income ratio. And is generally just everything lumped into one basket. It's a total ratio. So if you have $1,000 worth of debt and it's keeping you from qualifying for what you want to qualify for, they say, okay, pay off the debt with the $1,000 of monthly payments, and now that can be allocated to your house payment. So there's nothing that says you cannot have any debt to get a mortgage. The program that you are being qualified for requires that you have a lower debt to income ratio, which can only be accomplished by paying off your debt. This kind of circles back a topic that Jeb and I are going to be covering on the podcast in the next week or two, is basically red flags or things that you're looking for with a lender. You shouldn't have to go to a third-party source or jump on a YouTube live to get answers to this. Ask the person that you're working with, and hopefully they can give you a very good and concise and quick answer for it. If they can't give you an answer that makes sense and make it understandable to you, find someone that can. It kind of surprised me a lot of times. We get questions on here from people like, why are you working with the lenders and you have a broker? Why are they not able to explain this to you? That's not a tremendously complex concept. I would never go back to a borrower and say, hey, we have to pay off all your debt for you to qualify because it's the only way we can get you qualified. We say, here's the issue. Your debt to income ratio is at 50% and the housing to income ratio is 40%. If we pay off all of that debt, now we can have 10% more of your income to allocate to a monthly payment. It's not that difficult of a conversation to have with someone to help them understand why it is that we're suggesting that you pay off your debt.
Good stuff. Let's see here. And tone. Sure. Current rate is 3.25, but I want to add a second story. What is the best way to do this without throwing away that low percentage rate? Josh, is there a way to get cash without throwing out the current rate?
So here's what I always tell people. If we're looking at 3.25 is going to be tough, like I don't know that we'll ever see those again. And if we do, it's not going to be anytime soon. So you wouldn't count on, hey, just take a higher rate and then come back and refinance it in the future, because you probably, it's going to be a long time before you get that rate back. So in determining whether it makes sense to do a cash out refinance, you want to look at the size of your loan and how much cash you want. So if you have a $500,000 mortgage at 3.25 and you need $150,000 to put on that second story, you're looking at a second mortgage, because you wouldn't give up, 70%, 80% of that loan balance at a really low interest rate just to get access to that little amount of money. The blended rate would make more sense to take a higher interest rate second or a HELOC to finance the second story. Now, if you owe $100,000 on your house and it's $300,000 to put on the second story, that 3.25 rate is probably less valuable or less important. So you want to calculate, how much do you owe? How much do you need? What is available in terms of the market right now and interest rates for the second mortgage or line of credit, and then calculate a blended rate and see which makes sense for you. But in this instance, it sounds like it's going to be some type of second mortgage would make more sense for you.
Dude, so I just took some time and kind of went up through the comments, and we really got some comments going on here. We got Jay's back, by the way. Changed the name back to Jay. And looking for Dina's number. Darren's coming in saying Dina is cute, but next to Jeb and Josh, she's downright gorgeous.
That's rude.
That's fair.
It's rude.
Let's see here. Jeb is cuter than Josh. I think we should just end there. That's probably the best one to end on. I'll leave that. This is, Round Earth a moment ago said he bought in Houston, or someone bought in Houston. Ended up being an investment property, it sounded like, and also mentioned it wasn't cash flowing, but goes on to say, I'm not selling my house until I get a good profit. I'm waiting till the end of this decade. So I think a lot of people are in that position, right? You bought a property, maybe it's not the one, not perfect, but it is what it is. And a lot of people have locked in low rates and therefore they stay put. So we will see the standoff between sellers and buyers continue for the foreseeable future.
That one to me, Jeb, just never makes sense.
What's that? What part?
I'm not going to sell until I get a good profit. A
No,
good profit. So who defines what a good profit is? What if it's
each
40
person.
years before that happens? Round earth, right here. The comment you
No,
have
no,
right
I
on the
said, I
screen.
mean, to each person
Oh,
that's, yeah, it's relative, right?
but what I'm saying is, you just told us in 15 different comments that you hate the house you're living in, and you said, I'm going to sit here and hate this house until I make a good profit, which you have to define good, and you have no idea when that's going to happen. You also said another comment that you expect the housing market to crash. So you just said, I'm willing to live in a house that I hate in a city that I abhor for as long as I can imagine it's going to take for the market to crash and recover. I mean, that's crazy. So if you think the market's going to crash and you hate that house, sell it and get out and go somewhere that you're happy. Life's
Good
too
stuff.
short.
Good stuff. Let's see here. I just saw a good comment. Where was it? Where, Josh, what the hell happened to it? Ask about pre-approval. I mean, going to fully automated. I don't know where it is. I'll find it in a second. Sorry, guys.
Right here.
Yeah, there we go. Eternity Chris. We recently got pre-approval. Should we have our lender fully underwrite us while we are shopping around? Josh, is that necessary? I will tell
I,
you from my side, it's not necessary. Like, I don't need you to be fully underwritten in order to submit an offer for you. But from a buyer standpoint, should they have you go through that process, Josh?
if you're nervous Nelly, and again, if the person that you're working with, your loan officer, can't explain to you why that's not necessary, it can give you peace of mind. So by all means, what I would say, we do it about 3 or 4 times a year, and it's because it's not necessary for most clients. I've done this for my entire life. I know when you qualify. I don't lose debates with underwriters. So if I tell you you qualify, you qualify. Um, what we have is there's gray areas. The people that we do send to underwriting is because we're not 100% certain. I have a client right now that we did send to underwriting, get a full underwriting approval before we sent them out to look at homes. And the reason was, husband lives in Michigan, works for a family owned business that kind of requires you to be on site, but the family's saying, no, move to California and we'll continue to pay you, and you can manage this business from across the country. We had 3 lenders we sent it to. 2 of them said no, and one of them said, okay, if they say they're going to pay him that to manage from across the country. So it's weird stuff that fits into a gray area where we need to know that the underwriter agrees with us before we tie up a seller's property, when we would do that. Most situations, it's just not necessary. If there could be something uncertain about your income, there could be something uncertain about your credit that is in a gray area that we need an underwriter to be on the same page with us, we'll send it ahead. But like I said, we do it 2, 3, 4 times in a year. It's not something that's commonly done. But if you have time and you have a greater comfort level, or if you feel like it's going to give you strength when you're writing offers, there's nothing wrong with asking for it.
Good stuff. So we got a question here from somebody on Facebook. So I don't know if you guys know, we stream this to Facebook too. Questions rarely come in from Facebook. YouTube is where the audience is right now. There's 185 people watching. But Jay has a question. Says, can I assume or release my spouse on a VA loan during a divorce? So Josh, is that an option? So when you qualify to buy a house and you're using VA financing, your spouse essentially has to go on the loan. Is that right, Josh? At least their debts have to be part
And
of the equation.
in a community property state, we have to count their debts against them. They do not have to go on title.
Okay.
If they are on, they don't have to go on title. They don't have to go on the loan. If they are on the loan, you would have to go and talk to your servicer and say, I would like my spouse to be released. I don't think there's anything unique about the VA loan in this situation. So we could be talking about any type of loan, FHA, conventional, jumbo. What you would have to do is prove to the servicer that you qualify for the payments, and there's not an additional benefit to having another borrower on the hook for it. The reason why we're seeing questions like this, which no one had asked in the last 6, 7, 8, 10 years, is rates are so much higher right now that you don't want to do a refinance to get the spouse off of the loan and release them from liability. It could go either way. I could absolutely see a servicer going, cool, you showed us that you're the wage earner in the family and that you qualify and will be able to continue making the payment. I could also see a servicer saying, no thanks, we'd rather have 2 people that we
So,
could go after in the event of not being able to collect on the loan.
so Josh, with regards to that, so if I'm getting a divorce from a spouse, I'm not, by the way, but if you are, can you get a spouse removed with the service or without refinancing? Is that an option, or is refinance the only option?
You generally the refinance. You can ask. I don't know that I've ever had a client
Okay.
succeed with it.
I'm just curious. I never knew that that was even a potential option. So that's why I asked the question. So hopefully, Jay, that helped you with the answer there. Rafi comes back in and says, to Josh's point, I had to submit a work from home authorization if you are moving far away from your job. So he's on here, came back in, showed you that Josh isn't lying. The actual viewers here. So
That
good stuff.
and that one is common. It's common. Like 5 years ago, I don't know that I had any clients that were working remotely and would say, "No, I'm keeping my job, but I'm working, moving 400 miles away." Now it's pretty darn common, but the underwriter will just ask, "Hey, your job is 400 miles or 1,000 miles from your new residence. Please provide proof that your employer will allow you to work remotely."
All right, good stuff. We kind of addressed this question earlier, but we probably got some more people in here asking the same types of things, so we're just going to address it again. Gabriel says, "How much does it cost to buy down rates?" Josh, how much does it cost to buy down a rate?
So there is no hard and fast rule. There are rules of thumb. In general, when a lender is looking at making a loan, they have no idea when that thing might pay off. When they make 10,000 loans, they know on average they stay on the books about 4 to 6 years. So your break even on buying a rate down permanently is out at about 5 years, because for the most part, they're going to charge 1 point to go down 1/4% in rate. You want to go down 0.5%, it's 2 points. Once you get more than 2 points above or below, 0.5% in rate above or below what's the current par rate or 0 point rate, it starts getting less beneficial or more expensive. The reason being is lenders kind of want to stay near their par rate. So you want to buy it down 1/4%, it's going to cost you about 1 point on a typical day. You want to buy it down 0.5%, it's going to be about 2 points.
And then Jay actually says, buying down rates is like overpaying on your taxes so you can get money at the end of the year.
It's just a
S-
bet. No,
Similar.
it's a bet that you're not going to have an opportunity to refinance, and you're going to be in that property. So you're not going to refinance or sell for more than 5 years, and you know how to properly account for the time value of money. I do not recommend it, but there are times when clients insist that they know exactly where they're going to be in 7 years and 4 months, and this is the best decision for them.
Good stuff. Jane, probably the best comment of the night, says hit the like button, everyone. So please do that. Show some support if you don't mind. It helps us, helps more people see it. If you're listening to this on the podcast, rate and review us. That also helps more people see it. We're actually getting pretty good traction on the podcast at the moment. I think we are. A lot of people reaching out. So continue to listen to both if you don't mind. Listen to this tonight and then listen to it again on the podcast on Friday. That would be helpful.
Let this be all of your entertainment. Don't do
Yes.
anything else in your spare time other than
Yes.
listen to the two of us.
Genius. I think I like it. Jay says, when can I be a special guest on the show? So here's something I'm willing to have guests on the show from the audience. Like I want to have you guys on, but here's what I can't do. I can't just like send you a random link without like having never had a conversation. So if you want to be on the show, this is to everybody listening. If you want to be on the show, send me an email. We could talk off the air, probably do a little Zoom real quick, have a quick conversation, and then put it on, right? And then obviously we could set up a time and a link to do all of that. No, but I'd love to have you guys on. I think it's cool. It's part of the community. You guys support. I'm happy to put you on here. We can talk about things other than real estate if you want to do it. So you guys can find my email pretty easily online. Just type in my name. It comes up and send me an email. And we can definitely set something up where we can get you on here. Josh, what are the pros and cons of flipping a property with current rates?
I don't care about the interest rates when flipping a home. I do care about the future direction of the market. We talked early in the show that if I
But
were a
don't
betting
interest rates
man,
impact the future direction of the market?
that's what I was going to say. We talked about earlier in the show. If I were a betting man, I would say 60-40 odds that rates are lower 6 months from now than they are today. We also talked about if I'm wrong and rates stay elevated or rates go even higher, that's going to put pressure on home prices. So it makes it very difficult to project what your sale price is going to be. It was almost impossible for a flipper over the last 3-4 years to get themselves into trouble. You could almost was not possible to overestimate what you were going to sell that property for once you put it on the market. If your project, instead of going 4 months, goes 8 months, well, great, I got 4 more months of appreciation. It works the opposite way if home values are going down 4 or 5% a year and it takes you another 4 months. You just lost 1.5% of the value of that home. So interest rates will dictate how easy or difficult it may be to sell the property when it comes to market. It's going to make it very difficult for you to know exactly where you're going to sell. So what you're seeing is sellers are very hesitant to let properties go at big discounts because they're still clinging to where we were 6, 8, 9 months ago. And to insulate yourself from the uncertainty of what the market looks like in 4 to 6 months when you bring that property to the market, you need a bigger discount. So if you can get the house at the right number, I wouldn't hesitate to flip, but it's more challenging in the current market than it has been in recent memory.
There you go. Let's see here. I was looking at a property that my wife and I saw a couple months ago. It looks like they bought it and flipped it. Now it's back on the market. The one on Carbeck. Did you see that, Josh?
No.
Just looking at it. But anyway, we'll talk about it off air.
Ivy followed up with another question, or maybe
Yep.
before the
Let's
other
hit
one.
it.
So if you buy down a rate, you'd not be able to refinance for some time. No, you can refinance whenever you want. But let's say you say, I don't want to pay 7%, or more likely, I don't qualify at 7%, but I qualify at 6.5%. So I'll pay the 2 points to buy the rate down to 6.5%. You get a small monthly savings. So let's say in 6 months, rates are now 6%, and you want to refinance from 6.5 to 6. The 2 points you paid to go from 7 to 6.5, poof, disappeared. You didn't have the 5 to 6 years needed to recoup the expense.
Good stuff. And then Edson asked, is there a max on how many points can be purchased to bring down the rate?
If they're bona fide discount points by law, no. Everyone kind of interprets what the FHFA means or the CFPB means by bona fide discount points. So in practical terms, yes, there are limits on what you can do. But the most important thing is what we talked about. Once you get beyond about 0.5% lower than where the market is at, it gets more and more expensive to buy it down. So to go down another 0.25% is probably not 1 point, it's 1.5. And if you want to go down another 0.25%, so you're a full point below the market, it could be 6 points to do that.
Well, I accidentally clicked on this question when trying to put it in the queue, but we're just answering it now. Kind of curious what you guys think about some saying we are becoming a renter's nation. Josh, what are your thoughts on a renter's nation? I think here I'll start. I think there's definitely a bigger gap between haves, have-nots, a bigger gap in those with money, those with not, which makes renting, housing affordability more difficult. The last couple of years have definitely done that. We've talked about that. Those that owned property, those that owned equities, stocks, whatever it was, did better than those that did not. And renters, are paying the price by higher rents, by I think a year ago, we're up 9%. Rents are up 9% year to date from a year ago. At one point, they were up 18% over a year, according to Redfin. So, yeah, are we becoming a renter's nation? I don't know if I can say directly yes, but I will tell you it's putting a further strain on affordability, and more people are going to be in a position where they have to rent because of where housing prices are. But Josh, what are your thoughts?
There's some truth to it. We have some different issues. Like, I know those of you in other parts of the country where you're seeing these big hedge funds come in and buy huge volumes of properties because the cash flow works for them there. That would almost make you feel worse. But we're in a situation where we've had probably 10 commenters over the last 6 months say, this is nuts. I'm in Orange County or I'm in LA County. I make $130,000 a year. I can't buy a house. Um, that's a little bit crazy. It's a
No,
little
it
bit
definitely
crazy
is.
to me. I remember, 26 years ago, which was a long time. I'm a dinosaur. But when I started doing this, if I had a client that made six figures, I'm like, these people are rich. They are living the life. Now, husband and wife are going to be, closer to 200,000 to buy most of the homes in Southern California. I remember the first time I did a jumbo loan. We talked about what's a jumbo loan. These people bought a $300,000 house and put 20% down as a $240,000 loan. In 1996, that was a jumbo loan. I'm like, these are the richest people in the world. They're going to borrow $250,000. So the world has changed a lot, and housing has exceeded the value increases, everything else. And this all comes back to, someone asked earlier in the show, what do you think the government will do to help make housing more affordable? The government should sit on their hands for the rest of eternity, because the problems that we have today are caused by the government. The government did not let market forces come into play and wash things out and have a return to normalcy. And because of that, what they did in COVID, which dwarfed what they did in the financial crisis in 2008, made money really, really cheap. So the BlackRocks of the world could borrow at very, very low interest rates and buy these assets with nice yields on them. So we've financialized everything, where the low interest rates that were engineered by the government allowed these assets to appreciate to such levels that a lot of people can't afford. So unfortunately, there's definitely some truth to it. And looking to the government, or keep asking the government, or voting for politicians who are either deluded enough to think they can fix it with their policies, or willing to lie to you and tell you they can fix it with their policies. We need the government to stay out of the way and let market forces take control. But I don't think that will happen.
There you go. Wesley says, what tax benefits can be expected after a successful match via the Educated Homebuyers dating service? So, for those of you who don't know, we're looking to matchmake, guys. We're looking to find couples, whatever your preference is, two individuals. Maybe you're looking for a third in the relationship. Whatever it is, you're not able to qualify for the home that you want. I'm going to set you up with this person, a viewer of the channel. You guys are going to, it's going to be like Love at First Sight, that show, similar. You guys are going to move into a house and qualify, because, now you have more income because there's more of you, and you're going to be able to buy a house. You're going to have to live together. It's going to be great. It's a reality show we're starting. It's going to be fantastic, guys. Just wait. But the tax benefits are, you'll be able to get the deductions, the mortgage deduction, tax deduction, assuming you meet the income requirements there. It's going to be great. And if you get married, you'll get you file jointly. You'll be able to take advantage of that as well. And I think that just went up to like 27,600 or something crazy, or not crazy, but it went up. So yeah, great stuff, Josh. What other
The
benefits
the number
can they
the
expect?
number one benefit that you could hope for is that you get pushed into a much higher tax bracket, because we hook you up with someone who's making so much money that
Ooh,
none of these things are even issues. That would be the number one benefit.
wow, that's good. That is good. Kim says, is the debt to income ratio the monthly payments or the balance of each debt? So it is the monthly payments that you pay every month. So if you have a $500 credit card, it's not the $500. It's, say, the $50 payment, or whatever the monthly payment is. That's what they're adding to figure out your debt to income ratio. And sometimes on student loans, Josh, that can be a little bit different because of forbearance and all of the crazy things going on at the moment.
Our government has
Yes,
chosen to just kick the can forward with student loans, and apparently students are still suffering from COVID long after everyone has recovered. So is Jeb, is the final answer January of 2023 when payments start again?
I don't think so. I think there's people that want to get reelected, and therefore it could get pushed down further. I don't know.
Yeah, yeah.
I
So
might be wrong, but I think it could go, but who knows?
yeah.
Anyhow,
So
we will address that as it comes up. Robert says, what things should you do to prepare yourself for real estate? So Are we talking,
A career in real estate?
yeah, are we talking career? Are we talking buying a house? Maybe a little bit more clarification there would be helpful. But if you're looking to buy a house, some things to start thinking about are down payment. Do you have money for a down payment? Maybe where are your credit scores? Employment. Like, go through the pre-approval process, kind of see where you stand. It's helpful. It will, show you where you are in the process, at which point you can kind of work on the things that need to be quote unquote worked on, in order to get to where you're trying to go, in a roadmap, if you will. So Josh and I talk about it all the time. You could be 6 months out, a year out. Having a conversation now doesn't cost you any money, shouldn't cost you any money, and you can really see where you stand. And with that said, there's a link kind of scrolling there at the bottom, that'll get you in touch with somebody if you need to have that conversation. And Josh, what are some tips you can provide a solid offer in this market, to get one accepted? So here's the thing. I wouldn't know, because I'm striking out. I'm making offers above the asking price, coming in with strong deposits. We're waiving contingencies, shortening contingencies, giving free rent backs, doing it all and still not making any progress. So price, it all comes down to price. No, it doesn't, but it's a combination of things. Price is still probably the most important thing. And in what I can tell you in years of selling real estate, the majority of the time, the price is the most important thing to the seller. While there are other factors that they will consider, price has to be in the ballpark. So typically price is one. Secondly would be down payment, followed by escrow deposit, how much the deposit is, term of the escrow. If the property's vacant, do they want to close quicker? If they're in the property, they got multiple kids, a family, maybe they haven't even found a property yet. Do they need more time? Maybe a longer escrow is helpful for them. Um, you know, Contingencies, shortening contingencies is typically something, that listing agents, sellers like to see, getting through that process quicker. Maybe waiving some contingencies to make your offer look stronger. If you know you're a solid deal, like with some of my clients, we're waiving the loan just because I know when Josh tells me they're approved, we're good to go. So we're not worried about the loan side. Or maybe it's going to appraise because the one next door appraised for more, or whatever, and you're comfortable waiving that. So those are all the things you want to do. You really want to find out the motivation of the seller so that you can kind of build your offer to them. But even then, it's not a surefire in, to get your offer accepted. Depending on where you are, there might still be some competition out there. We've lost out in the last couple that I've put offers in on. Again, above the asking price, strong down payments, all of the stuff that I just mentioned, just because there were multiple people looking at that property and they were willing to offer more than we were. So,
Jeb, I'm going to
yep. And get your
tease.
loan officer involved. Loan
Get your loan
officer
off.
involved to have a conversation. But even then, Josh was involved and we still didn't get anywhere. So
Two pieces that I was going to say is make sure you're dealing with a realtor that's cool and a loan officer that's cool. And by that I don't mean that they look like the fawns. I mean that they work well with others, that you're reaching out. I mean, Jeb, I think these people would be shocked to know how many times a realtor will just send over an offer without even a phone call ahead of time to sort of grease the skids, get some information, develop some rapport, build a relationship. So make sure your realtor is doing that. Make sure your loan officer is copied on that. I can tell you I've had many wonderful conversations with listing agents, that have gone nowhere because they got a much better offer. So it's not magic, but I would say it goes a long ways when it comes down to 2 or 3 offers that are being considered with 4 or 5 offers. So what we're going to say is I want to tease next week's podcast. Make sure you tune in, make sure you listen to that, because we talk a little bit about how you can get a deal in the current market, and we talk about the 3 sort of tiers of the market that we're seeing here in California. The beautiful turnkey HGTV homes, those are getting multiple offers. So if you want to get an offer accepted, don't go and pick the most beautiful home in the neighborhood. You can pick a nice home, you can be in a great area, it can be in a good school district, but don't pick the one that someone has put into perfect turnkey condition, because there's a lot of other people wanting that property, even though there's not necessarily a lot of buyers in the market right now.
good stuff. So while you're going all over that, Jay's hitting on Dina in the chat. We find out, he wants to ask if she wants to be a traditional wife.
we have a rule of not blocking people, but Jay, if you're harassing the other viewers,
She seems to be playing along. I don't
okay,
know. Maybe,
okay.
what's your Insta? Oh, we got like we're asking for handles now. This is getting good. I don't know. If you feel threatened, let
This is a
Josh know.
safe space for all of our viewers. We'll have a safe word. Just if
Safe
someone
word.
if someone throws up block in all caps, we're going to know that their harasser gets blocked. Otherwise, we'll allow it.
All right, there you go. Patrick says, "Do I officially need to be licensed in real estate to start making money during a property purchase transaction? Anything contractual for finding potential buyers for sellers?" So yes, in theory, you should be licensed before you do any type of real estate transaction. Um, yes, that's the easy answer to that. Yeah, yeah, yeah. Let's see here. Habil. What market force could possibly get BlackRocks of the world to release some of their single family homes back into the market? Now that they have them, why would they ever sell? It's a question that I've pondered myself. What would get some of these big conglomerates, if you will, that are holding a ton of property to release some of them to the market? I don't have the answer. I mean, if they were able to get a better return in some other market that was guaranteed, that was a fixed return, or they could use that capital to do something else. I mean, what happens is when they sell, real estate or whatever, there's some gains there. I don't know if you can roll that gain into anything other than real estate and avoid taxes. I mean, I know the 1031, but I'm not sure if there's any other potential tax shelters, if you will, that allow them to roll out of real estate and avoid anything where they've got these gains. Josh, are you familiar with anything?
No, and I like the question because I've thought about it and I haven't come with any significant answers other than a lot of times their financing is short term, not meaning in months, but not a 30-year mortgage. When hedge funds are borrowing, if rates stayed elevated and their borrowing costs, they had to roll over their financing, and rates were higher, the yields may not make sense to them. If you've watched for any period of time, I don't expect that to be the case. I do expect rates to moderate at a level higher than they have been, but not nearly as high as they are right now. That as long as the yield makes sense, for all of the reasons we talk about home ownership making sense for you guys, for an American, 65% Americans that choose to become homeowners, is why it makes sense for them. So as long as the financing is simple and easy, the way it has been for them, I don't know what we can do to force those back into inventory. And right now, if we're talking about a market that's stalling out, do we want that? Do we want to have a bunch of inventory come into the market? You may say, hey, I can't afford and I'm not in the market. I absolutely want that. Well, what if it caused values to drop 10%? Are you going to be a buyer if the market's dropped 10%? Everyone says they will be. In my experience, I don't see when we're seeing that type of a market, I don't see people jumping in. I'm going to wait. I'm going to wait another couple months. I'm going to wait 6 months. I'm going to wait till next year. And they generally wait many, many years until it's obvious that we're back in an uptrend.
Good stuff. Sean says, "How does one submit a question?" You did by typing in the chat there. So if you have a question, type it in. That would get it where we could see it. Two. Any recommendations on how to find a general contractor in a specific area? I do not know anyone in the area. Not really. Find somebody that is, that you like, you trust, that's had a good experience. I mean, that's really a referral of some sort is really how you want to find somebody. You could do the Google review thing, but you need to vet them, ask for past clients so that you can have conversations, see the work they've done, make sure they are who they say they are. A lot of these people are on the Better Business Bureau. You can check them out. Contractors, make sure they're licensed, do all the proper stuff. But outside of finding them, it's no real easy answer. I mean, anybody I'm working with or trying to work with, I'm trying to get it from someone else. I'm trying to get a referral, just like pretty much anything.
And do your due diligence. Just interview several. If you already have it, if this is relating back to the flipping question, if you have a property under contract and you don't have someone that you trust in the area, get three of them out there and compare and see where the numbers are off. Ask them, why is this number this? Why are you charging this? It's really the only way to do it is to go through it. Don't be afraid to ask questions on the front end. You will regret it on the back end if you don't.
Ariel says that he told me rates were going to 8% and that he's basically saying, I told you so. Well, guess what, Ariel? Rates aren't at 8%.
Don't rates need to be 8% before someone would say, I told you
Oh,
so?
boy. So they're not there yet, my friend. So when they come back, you can post that. And if they don't, you owe me an apology. All right. Where are we at, Josh? An hour 36. And how many people have hit the like button? Only 90 people. That's pretty performant. People don't really
Hey,
care for us, man.
a
They're not
lot
finding
of
value in the show. Is it me or Josh? Is it me that you don't find value? Is it Josh? Because I can switch this up. You know, I can't really get rid of me, but I can get rid of Josh. If you find more value in getting rid of Josh, hit the thumbs up. If you want to keep Josh,
Jay said
hit
you're
the thumbs up.
prettier. That's the comment you've got so far, that you were prettier.
I mean, that's fine. Listen, people want to look at pretty people. I mean, it's simple. When I look like Travis Barker on this, it's going to start on Friday. Going to have to go into Saturday because it's going to take me so long to put on all these tattoos that by Saturday, you guys won't even know who I am. That's all I'm saying. And maybe that's a good thing. Maybe that's a good thing for the people who don't want to know who I am. Let's see. I am a flooring contractor. It's amazing how many fellow contractors I have met at Home Depot. There you go. Walk around Home Depot.
That was I like that tip, but not just Home Depot, anywhere. Like you can get not necessarily general contractors, but flooring contract. Go to a flooring place and say who are the best contractors you work with. Go to a window place. Who's the best contractor you work with? And I wouldn't even say who's the best. Say this is what I'm looking at doing. We're looking at a full renovation in the $100,000 range of a $500,000 property. We're looking at whatever it is. Be as specific as possible because there are different levels of contractors. My preferred contractor when I was flipping houses was middle market. He was really good at that. If you were building a custom home, he was not going to be that guy. If you were building or working on an entry level project and you're trying to cut corners everywhere, also not your guy. But your bread and butter, someone really nice single family home, he was very good at it. And that is, you're going to find that everywhere. These contractors can be a great contractor, but not a great fit for you. So be specific about what you're asking for when you're asking for referrals.
Good stuff. Good stuff. Habil? I keep butchering that. Can we trade Josh for a nice beach house? Sure.
You get way more than that. You get that Malibu beach house if you trade Josh.
Hardly, bro. Yeah, if we get rid of Josh, I'll start doing these in a nice beach house with a back, nice ocean view in the back. It'll be great, guys. It'll just be wonderful. Let's see. We don't really have a lot of questions.
Let's be realistic. Monica said what everyone's thinking.
Good. Hey, Angela, way to show up as Monica on here.
Yeah.
Great.
Yeah.
Good job. That's his wife, by the way. She's
that's the only one. That's the only one whose opinion matters. That's the only one whose opinion matters, Jeb.
Let's see. Sean says closing on a new build home with a 6.6 interest rate on the 31st. First home and getting kind of stressed due to the market, but rent in my area is quite similar to how much I am paying for a mortgage. So, yeah, good. I mean, listen, I mean, that's the best case scenario. I mean, because honestly, like if it's close to where your rent are, if and when rates come back down, you'll be in a position to refinance and the payment will likely be less. So, there are still places out there where you can get a mortgage, get a house for what it costs to rent. And so if you're in one of those markets, it probably makes more sense than other markets. Let's see here. I don't know how to do the name. How many months of inventory in Huntington Beach? So we have how many months of inventory? I don't know the months. I know we have 200, what I say at the beginning of the show, 254 properties on the market. I don't know how many months that goes into because I don't know how many closings actually happen in the month on Huntington. Actually, let me do this. I have something real quick. oh, I'm going to answer this question while we're here because I have a program that will tell me that. It's not really something I follow just because it's so for attached homes, we have 2 months supply. For detached home, 2.1 months supply. And that might be a little bit different just because this is from September. Inventory hasn't really changed, but let's just say 2.5 months of supply. So there you go. Josh, just you and I talking, bud. Nobody wants to.
No one has more questions. They're probably, it's Wing Wednesday. They're probably at the bar already.
They are probably at the bar. That's you probably nailed it. That is it. Okay. Well, Josh, should we just end it here, or what do you want to talk about? Something else, or
We can talk offline.
we can talk offline. So Josh wants to get to Wing Wednesday. Don't have a lot of questions. So, what I'm going to ask is that if you found any value tonight, hit the like button, subscribe to the channel, follow us on the Educated Homebuyer podcast, listen to us. You want to see me transform into Travis Barker this weekend, follow me on Instagram. On TikTok, I'm posting short form videos, Instagram posting short form videos. So just follow me everywhere and you'll get a good idea of who I am. So anyhow, Josh, what do you want to say as we exit tonight, my friend?
Be safe. And are we back before Halloween? No, it's going to be Halloween before we come back. So enjoy, get lots of good candies, all of that fun stuff, and don't get run over or anything.
There you go. All right, guys. Until next week. Adios.